So hi everyone. Thank you for taking the time to join us from your busy schedule. At ALTPORT Experts, we are experts in AIF and PMS, and we are thrilled to announce our brand new show, which is Ask the Expert Show. Through webinars, we aim to share insights into diverse asset classes, forecasting, knowledge exchange among our investor community. So my name is Devanshu Mindish, and I am the Vice President of ALTPORT Experts India. With me, I have a speaker, Alok Agarwal ji, Head Quant and Portfolio Manager at Alchemy. Let me take a time and introduce Mr. Alok Agarwal. Alok Agarwal has 22 years of experience, specialties in equity fund management. He joined Alchemy in 2022, having previously managed key equity funds and headed the offshore equity desk at PGIM India AMC. He has also worked with Deutsche Asset Management Company, KR Choksi Securities, Tata Group, and Pinnacle Academy. Alokji holds multiple degrees and certificates. So he is CA, he is CFA, and CMT certifications, and as well as he is master degree in commerce and finance. Welcome, Alokji. How are you?
A pleasure being here. All well here.
So, Alokji, you can take over from here and you can start.
Sure. It's a very interesting times in our markets. The last 5 years, especially the post-COVID, initially saw a big up move, and thereafter the last 2-3 years we have seen some up moves and down moves as well. And after COVID, first 4 years of profits are super normal, very good, and some moderation in that is what is being visible right now. In such a scenario, when different styles are being favored, different types of stocks and sectors do well, how should one navigate this markets? That's a broad idea that we have. And we do believe that being a little more nimble, a little more adaptable is what is required. And based on that, allow me to share my screen. Let me share a few insights about the markets, and thereafter I go into the product as well. An interesting part about this year, this calendar year so far, has been the kind of correction we saw in Jan and Feb. We update this slide at the end of every month, so this data is as of 30th June. Let's look at the left-hand side. The BSE 500 is up little over 5% this year as of 30th June. But the top decile performers of last year, that is the top 50 performers of last year, on an average are down 6%. This is a rare gap. This minus 6% and plus 5 is a gap of around 11%. It's a rarity. If we go in the past, not too many such instances are there. Similarly, this has showed that the market was simply wanting to book some profits in some of these names. But how narrow the market was, for that, let's look at the right-hand side. There are 5 different indices mentioned. For every index, there are 2 different data points. For example, if you go to the last one, BSE 500, it shows a data of minus 4.4 and a data of minus 19.7. What 4.4 means is that from 52-week high, this index is down 4.5%, just 4.5% from the highs. But more interestingly, the median stock is down more than 19.7%. When I say median, it means at least 250 stocks out of the 500 are down at least 19.7% from their peak. So like more than half the stocks are down close to 20% or more from the peak, whereas index is down only 4.5% from the peak because the top 10 stocks refuse to budge in the Jan-Feb fall. This gap of 15%, difference between a 4.4 and 19.7, this is also a rarity, quite reminiscent of what happened in 2018. Almost it feels like what happened in the full year 2018 got compressed, especially in the months of Jan and Feb. The same thing is true across all indices, whether it is Nifty, Next 50, mid cap or small cap. But earnings growth wise, the numbers are a little different. If you look at the last quarter's numbers, which was a full quarter of quarter 4, while the Nifty 500 reported earnings growth of close to 12%, the breakup between large, mid and small was quite interesting. So out of this 12% growth, the large caps grew 8.2%. But within the large caps, which is top 100, the Nifty 50 grew only 3.4%. And we all know they are disproportionately large in terms of their contribution to the Nifty 500. So if out of 11.9% for 500 companies, if top 50 companies grew 3.4%, the bottom 450 companies, look at the last row, the Nifty 500, excluding the top 50, they grew actually at 22%. So the actual growth was in the bottom 450 names, but especially what we saw in first 2 months of this calendar year was that within that Nifty 50, the top 10, 15 names did not fall much. That led to a very different kind of a scenario across the markets, indices, and the broader portfolios. As far as the economy is concerned and corporate profits are concerned, what stands out is that the corporate profits are growing at a reasonably decent pace. From FY20 till 24, that was a fast pace. We had nearly a 25% CAGR in earnings growth, as a result of which, from a 2.1% profit to GDP contribution, we went to 4.7%. This year also, we grew slightly more than the nominal GDP. That's why this number of 4.7% stands at a 17-year high, highest since 2008. And that just shows that the corporate profits are actually rising in a much better way than the nominal GDP. Last time we saw a series of increase in these numbers was in the period of 2003 to 8, and this time it has been from 2020 to 25. During that time also, it was a very strong market. This time around also, it has been a very strong market. We expect the numbers to continue to do well in terms of the corporate profits growth, while the nominal GDP growth is expected to report around 10-11%. We do expect the corporate profits growth led by Nifty 500 to have slightly more than the nominal GDP growth. An interesting fact as to what happened in our markets in the last 1 year. September onwards, we saw a correction in the market, which carried on till at least Feb, to an extent till April. But thereafter, we saw a reasonably good bounce back. Let's see what happened here. The arrow shows that these are GST collections year on year, which is the closest to data for the overall economic activity. And that data was which was well within above 10% prior to July 24. But from July, August 24, it started falling. And in fact, from September till December, these were 4 months of single-digit GST growth, which is a rarity. And as a result of which, the markets were trying to embrace the slowdown. Thereafter, there was the US election, and markets were ready to embrace the changes that could come in because of the change in policies. That led to that widespread correction from October till Feb. Thereafter, the GST collection numbers have been rising. They look pretty okay now. And we do expect the numbers to continue to report reasonably okay numbers. So that's where the recovery has been, and that's where the markets have been a little more positive as well. What do we do in such a scenario? Why do we have this particular strategy called Alchemy Smart Alpha 250? What is it required to gain that consistent higher alpha? Our study of the past shows that bulk of the funds or fund managers or maybe fund houses, they had a particular investment style. When that style is in favor by the market, the funds show very good returns, disproportionate returns. But when that style is out of favor, suddenly the overall return starts looking a little dismal. For us, what was important is, instead of having one particular investment style and wait for the market to start liking it, why can't we respond to the changing market cycles in a way that the relevant factors, the relevant things are given more importance? With the objective of generating higher consistent alpha, we use this strategy wherein we would adapt to the changing market realities. And for that, we created a framework which we call an EQGP framework. While doing this alpha generation, we are concentrating only on the top 250 companies by market cap. Loosely, we can call it large and mid cap. I'm not exactly calling it large and mid cap because the AMFI definition of large and mid cap depends upon 30th June and 31st December 6 months average numbers, whereas I look at top 250 companies by market cap as of yesterday. So one needs a revision every day. But nevertheless, top 250 means that at least very small companies cannot appear in this fund. Coming back to the framework that I use is fairly simple to achieve the overall objective. My objective was that I create a decent alpha over the benchmark consistently by adapting to the changing market cycles. Do not take any exposure in companies beyond 250 names, so it's fairly large and mid cap. Not having any concentration in the fund by having 25 stocks. Not taking cash calls by always being fully deployed, almost like 1-2% cash may be there. And then be capital efficient with majority of the gains coming from long-term capital gains. With this objective in mind, the framework we have is an EQGP framework. What do I do here? Each of the top 250 companies have to undergo lot of tests and lot of variables for which they are evaluated. The number of variables could be several hundreds of variables, but it was important for me to categorize them into 3 parts. The first category of variables is the test of a company's quality. The second category is the test of a company's growth. And the third is the test of a company's price action. A price action can be loosely called momentum kind of factors. So 3 different categories, quality, growth, and price action, based on multiple variables on which they're evaluated. A score out of 100 is assigned to each of these variables. A score out of 100 for quality, a score out of 100 for growth, a score out of 100 for price action. But in order to compare the 250 companies and rank them, I'd obviously need an overall composite score. If I take a simple average of the 3 scores, I'm indirectly giving equal weightage to quality, growth, and price action. But as we said, we want to adapt to the changing market cycles. So for that, we need to assess what kind of market cycle we are in, for which I introduced this variable E. This E is market environment. It's almost like a pitch report before a cricket match, where the captains would try to assess the pitch to understand whether we have to play aggressive or defensive. This is exactly what I do here. The market environment, which is a study of economies and markets in general, I evaluate this on a scale of 1 to 100. The higher the score, the stronger the market. The lower the score, the weaker the market. The higher the score, I need to be more and more aggressive. The weaker the market, I need to be more and more defensive. That was the logic, philosophy on which this has been built. As we can see, the mid number is 50. If this needle moves on the right-hand side, which is a stronger market, that is the time I will be aggressive. And how can I show that I'm aggressive? By paying higher weightage to price action, then growth, and then quality. And when the needle is on the left-hand side or moves from right to the left, how do I show that I'm getting more defensive? By giving higher weightage to quality, then growth, and then price action. Please remember, it's not a binary function. That right-hand side is aggressive, left-hand side is defensive. So these are the weights. The scale is from 1 to 100. What do I mean? If the score is 55, which is a strong market, I will be aggressive. But if the score moves to 70, which is even stronger, I will become even more aggressive. And you can see from this place to this place, the brown band is expanding. This brown band corresponds to price action. So if the price action weightage goes up and the quality weightage goes down, even within the 55 to 70 number. So it's a step-by-step, level by level adaptation to how the market climate is. If the market environment continues to be conducive for strong action, aggressive positioning, that's how it is done. Let's have a look at, if the score was 100, look at the weightages for price action and how small is quality. But suppose from 100 we start going back towards 0. See how the quality weightage goes up as we go back from 100 to 50 and then 50 to 0. So at every different level of environment score, there's a different combination of weights used, but the hierarchy is guided by this. Above 50, obviously price action will be highest and quality will be lowest. And below 50, always quality will be highest, price action will be lowest. This simple method ensured that the consistency of the fund goes up, and more importantly, the ability to generate alpha goes up. When I say consistency, I'm not talking about every month or every quarter or every year. I'm talking about more in terms of 3-year rolling kind of numbers. I'll come to the flow chart now. Simple. Step 1, top 250 companies by market cap. And step 2 is evaluating each of these companies for quality, growth, and price action. Thereafter, the environment score in step 3 decides what will be the ratio or weights in which they will be mixed. Once I have the scores in step 2 and the proportions in step 3, multiplying them gives me the weighted average score for every company in step 4. The top 5 companies in step 5 go into the portfolio, which is top 25 out of top 250. So top 25 companies or top decile companies go into the portfolio, remain there as long as they do not breach a particular threshold. When that threshold gets breached, that's the time the stock goes out, otherwise remains in the portfolio. The idea is let the winners, let the potential multi-baggers remain in the portfolio, and let the weakest link go out to be replaced by the next best potential multi-bagger. So this process itself means that it's the weaker or weakening names that are culled out. The winners are allowed to run. Just to give a glance as to what are the factors that go into the creation of this environment, as we said that it is primarily the look at the economies as well as the markets. It's the liquidity conditions in the market that is most important. The interest rate conditions, the higher the liquidity, the better it is for the markets. Falling rates or expected to fall rates are good for the markets. Rising growth is good for the markets. If the deficits are going down, that's good for the score. If risk-on assets like equities and cryptos are doing well, it is positive. But if the risk-off assets like gold and bonds are doing better, then that's negative. If corporate profits are rising more than the nominal GDP, it's positive. If the currency is stable, it is positive. If the policy levels from support from government is there constantly, then that's positive. These are the broad numbers, broad variables I could share. Obviously, it's not the exhaustive list, but it gives you a tentative idea as to what decides as to environment is positive, strong, or not. The other factors like quality and growth are little more regular numbers to look at. So while we look at the ROEs, the leverage ratios in terms of debt, the economic value added, the cash flow generations, in this, one of the highest weightages is given to management quality, which is more of a subjective rating given by me as to how the management has been. If the management has been fair to the minority shareholders, they get a positive score. Otherwise, they get a negative score. Similarly, growth, while in growth, profit growth, sales growth, the operating profit growth, all are important, but overall market share gains are given vital importance in this category. And price action parameters, as the name suggests, as I was saying, it's loosely momentum-driven factors. So while tailwinds in price behavior is nothing but momentum, while absolute tailwind or absolute momentum is important and we give importance to it, but we give far more importance to relative strength or relative momentum in the stock. For example, if a stock is up 30% in a year, it is said to be a good performer. But suppose in that year, the markets were up 40%, then suddenly that 30% starts looking inferior. If in our world, and as it is, our objective was to outperform, to create that alpha. So alpha itself means a relative concept. That's why the relative momentum is given far more weightage than the absolute momentum. But it's not just about momentum factor. That's why I wrote this price action. The ownership trends as to what the promoters, FIs, and the domestic institutions are doing, whether they're buying or selling the stock, that also determines the price action score. The consistency of outperformance in the past, that also determines. And more important, whether the stock is liquid enough in the market or not. Sometimes something may be there in top 250, but it hardly barely gets traded because of the very low float. If the liquidity is low, it gets a negative mark because even if price returns are good, it has to come with those volumes to execute. I could not have shared all the variables, but these variables was just to show the flavor as to what goes into the creation. We have almost completed 2 years now, and what we saw in the portfolio so far has been that in last 2 years, that is from August 10, 23 till about June 30, 25, during this period, nearly 2 years, the portfolio generated a return of 28% annualized post expenses compared to index returns of around 19, 19.5. 19.6 is BSE 500, and the relevant index is 19.1%, which is BSE 250 large mid cap. And hence it created an alpha of about 9%, close to 9% for BSE 500. And as it is, I would say like a 9% alpha, reasonably decent, good alpha to have, as we were mentioning. And again, to highlight that our objective has been to generate higher consistent alpha. And for that word consistent, I would say 3-year plus is a much better numbers to look at. When we did our backtesting, we saw that various rising and falling periods in our markets, the fund generated decent alpha over these periods. Say from Jan 13 till August 13, when the markets fell 13%, the fund also fell 13. There was no alpha. But next 1.5 year, August 13 till 15, when the markets rallied 71, the fund rallied 148, and so 77% alpha, and so on. Notice this alpha column in the last one is fairly consistent across all cycles. Of course, data before August 23 is taken from backtesting data. What this of 9% alpha ensures that the fund actually is not just ahead of the index, but has been ahead of a lot of peer products, both in MF and in PMSs. This is how the portfolio composition looks as of 30th June. So the left-hand side, instead of showing large, mid, and small, what I wanted to show was that as of 30th June, 37% of the fund is in those stocks which are in top 100 companies by market cap as on that day. And 62% is in those stocks which are in the next 150 companies by market cap as on that day. So it's not a large, mid, small, simple classification, but it just shows as on that day where there is the component. If you come to the sectors, you notice that some of the large sectors like oil and gas is completely absent. FMCG is completely absent. IT is barely anything, just 2.6. And the fourth one is banking, which gets confused with financials. While we have financials 33% here, but out of this 33%, only 3% is banks. The remaining 30% is non-banks. So it's very different from the key index, where the key heavyweight sectors are barely there, but wherever the visibility had been higher, those have been taken into the portfolio. A look at the top 10 stocks by weightage in the fund just shows that how different it is from the main indices. Right from BSC, Trent, Hitachi, none of the major large companies are there in the top 10. Interestingly, how the portfolio metrics look, that's an interesting part. That if you notice, all these numbers are taken from Bloomberg. The 1-year forward P ratio of the portfolio is at 42 times compared to the index at 23 times. So looking at the valuation, it's pretty expensive. But if you look at the next 2 years earnings growth estimates, for the portfolio, it is 29%, but for the index, it is 10%. So we paid little less than double for valuation, but what we got was almost 3 times the growth. So to understand the reasonableness of it, we should look at PEG ratio, that is P divided by growth. The P is 42 divided by 29% gives you a 1.5 times PEG compared to 2.2 times for the index. Looking at the peg, it is pretty reasonable without compromising on quality because ROE is higher and debt equity is lower. That shows that this portfolio is pretty strong in its nature. See, if I need to create a higher return, if I need to have a decent alpha, my companies also need to grow at a decent numbers. Otherwise, how would that alpha creation or return creation come? Some of the case studies, Trent is an example which we bought at the inception of the fund and was held in the portfolio even till 30th June, creating a return of little over 3 times. Similarly, Dixon, which was bought in the inception of the fund, got exited in May, creating a return of 3 times. What I'm trying to show here is the fund has a capability of identifying multi-baggers and nurturing them, but also exiting them if we feel that some of the building blocks of being multi-baggers are not too valid from here on. We may be right, we may be wrong, but it's all about the incremental calculation. Similarly, PFC earned us nearly a double the returns over a short period of time. For us, entry exits are as important as entries. 63% of the stocks underperform the index after our exit. So typically, everybody looks at only the stock that did well. We track our exits for 1 year after exit also. And if 63% of the stocks underperformed after the exit, just shows that despite creation of 9% alpha, that means you had winning stocks, the exits played a vital role because 2/3 of them underperformed post the exit. An interesting point here was Berger Paints, which was exited in October end 23. Since October 23 till now, while the market is up 42% absolute, the stock is up only 5% absolute. Just shows how it helped. But more importantly, on October end, when that stock was exited, the stock that we entered was Prestige, 2nd November. And imagine that stock gave a return of 132% over a period of just 9 months. So being vigilant, being able to not just identify, but able to nurture and then take a call to exit, that helped in generating a lot of such gains by switching from the weakening one to the potential multi-baggers as well. That's a level that how this fund could generate those kind of returns. When I compare this with some of the smart beta kind of indices that are there, I took my backtesting number of Jan 13 starting point till the latest reporting numbers. I compared with the very popular momentum index called Nifty 200 Momentum 30 Index. And we found that this strategy actually was ahead of that momentum index also over this 12.5-year period, outperforming by nearly 9%. Of course, these are before costs, so I need to deduct close to 3% cost on this to compare. So much higher return for similar risk profile. I think I'll stop here and possibly we can now get into the question answers and that will help us go deeper into the product.
Thanks, Alokji. Thanks for presenting your wonderful fund. So, my investors are asking, what do you think in the upcoming days? Where does the market look like? What is your thought on markets?
So what we saw after the massive correction in Jan-Feb, while everybody was fearful, the next 4 months staged a solid comeback. So in the last 4 months prior to the current one, like if I'm correct, Nifty 500 in March was up more than 7%, and each of the next 3 months was up somewhere around 3.5%. That's a big number to have in 4 months period, close to 20% rally in the key index. After a 4 month strong rally, what we are seeing is some consolidation in the month of July. So near term, 6 months, 12 months is very difficult to say, but I'll be surprised if over the next few years, if India doesn't report a 10-11% kind of nominal GDP. That's what our expectation is. We expect corporate earnings numbers to be slightly ahead of nominal GDP. So if the nominal GDP grows around 10-11%, the corporate earnings should grow somewhere around 12-13%. And the earnings grow 12-13%, almost similar number comes through in the index returns. So broadly speaking, we should be able to get to early teens in terms of earnings, index returns over the next 2 years. And that's what our estimate is. And of course, with this strategy, our endeavor would be to create a decent alpha over and above those index returns as well.
Thank you. So one of my investors is asking, what style, will be more suitable to invest in from now in the upcoming markets? Either it is growth, value, contra, or contrarian.
Things change pretty fast in these markets. And in my view, it's primarily the higher growth and visibility and certainty of higher growth, all three. So growth needs to be just not just higher, but not just for 1 or 2 years. It should be for slightly longer years. That's why visibility is required. And the certainty also. It should not happen that you are expecting for 30-40% growth and the company comes up with a very small growth from then on. So higher the growth, higher the visibility of growth, and higher the certainty of growth, the stronger a company, and that is what is being rewarded currently. These phases keep changing in the market, so we should bear that in mind. Market suddenly may decide that no, for me quality is most important. Market may suddenly decide no, again for me now momentum is more important. We need to respect market decisions and change or maybe adapt as we can. That's what we are trying to do in our strategy.
Great. So thank you, Alokji, for giving your valuable time. Thank you, investors, for joining this webinar with us. If you have more queries, you can write down to me at devanshu@aifpms.com, or you can call us at 8368586435. Thank you.
It's so much pleasure being here. Thank you.